Okay, let's take a look at chapter 2. Okay, so now we're going to talk about recording business transactions. There's a lot of very important concepts in this chapter, some very basic things that we really need to get a grasp on and remember. Okay, so this is going to be a very important chapter. Okay, first thing we're going to talk about is the accounting process. The first step in the accounting process is to record transactions in the journal. Okay, transactions are economic events that impact the organization. The journal is the chronological record where these events are recorded. So it's like a book, and for each time there's a transaction, you put the date and then you put the transaction. And they go in chronological order, so you can always find them. They're always going to be in date order. At various intervals, the transactions are posted to the ledger. We'll talk about what the ledger is in a little bit. The ledger is kind of like a book that summarizes all of the different accounts. Okay, so there's recording transactions in the journal. And from there, we copy them to the ledger. And in the ledger, basically, as we said earlier, in the ledger, each page is an account. And an account is the activity plus and minus for whatever that subject is, whether it be for cash, accounts receivable, for some other asset or whatever, a liability. In the ledger, each page is an account for whatever. Okay. Once we get to the end of the accounting period, usually they do this at the end of a month or a quarter or a year, then you're going to do what we call a trial balance. And it's just as the name implies. Remember, we talked about the accounting equation: assets equal liabilities plus owner's equity. What we want to do is we want to make sure that at the end of all these transactions that we've put in, that they balance, that equation holds true. And that's what the trial balance is for. If the trial balance doesn't work, if assets don't equal liabilities plus owner's equity, then what that means is we've made a mistake somewhere. And now we've got to go back and find it. Better to find it now than to keep going and have to go through that much more to find whatever our mistake was. Okay, so the account is the basic summary device. It's a detailed record of increases and decreases in specific assets, liabilities, or owner's equity during a period. The journal is the chronological record of transactions organized by date. So it's a separate book with all what we call journal pages in it. And the journal pages are designed so that you can put the date and then the different accounts that were affected by that transaction and what the amounts were. Okay. The ledger is the book with all account activity. So each page in the ledger is for one account. Our journal shows the accounts and how they were affected. All we've got to do is copy those into the ledger on their respective pages. And then the trial balance is when we list all the accounts and their balances. Now, if the accounting equation holds true, then I should be able to take all the accounts, add them up, and they should equal. The two sides should equal. And I'll show you what we mean by that shortly. Okay. Again, here's the accounting equation: assets equal liabilities plus owner's equity. So the accounts are going to be grouped in these three broad categories. Little review: assets are economic resources that will benefit the business in the future. For example, cash. Accounts receivable, that means something that people owe us. So we're going to receive it. We're going to receive the cash that they owe us. Notes receivable is when we let somebody borrow money and they're going to pay us back. That's a receivable. We're going to receive it. Prepaid expenses are when we pay an expense for something, but we haven't used that expense yet. And we'll talk about this in greater detail later. But an example could be rent, for example. If I paid 3 months worth of rent, then technically I've paid for it, but I haven't used it yet. This is only the first month. Next month I've already paid for, so I can stay in the building then. Third month, same thing. If I paid 3 months, I won't owe until after that third month. That's considered an asset because by paying that, I'm going to enjoy the ability to stay in that building because the rent's already been paid. That's called prepaid expenses. Then land, building, equipment, furniture, fixtures. Fixtures could be anything from shelving units to display cases. Liabilities are creditors' claims to our assets. Okay, in other words, we owe people things. Accounts payable is the opposite of accounts receivable. That's the promise to pay a debt arising from a credit purchase. Okay, so this time we made the purchase, we received something but didn't pay them yet. So that's why this is the opposite of an account receivable, because instead of receiving it, now we've got to pay it. Okay, notes payable is the opposite of notes receivable. This is when we borrow money and have to pay it back. And then accrued liabilities. Accrued liabilities is when somebody pays us or gives us something, but we don't give them anything back. For example, a service contract. If I ran a computer company and I sold computer engineering services, somebody might pay me for a whole year's worth of services, but until I actually complete those services for the year, then I still technically owe them something, okay? That is considered an accrued liability. And then owner's equity. Owner's claims to the assets. We talked a little bit about capital, the net worth invested by the owner. Withdrawals are when the owner takes money out, takes something of the assets for personal use. Revenues are, that's the money that we make on our day-to-day business. Okay, whatever it is that our business is, as we make money, money in, money out, that's considered revenue. Expenses, that's the cost of doing business. That's whatever we have to pay out in order to run our business. So this is kind of how it would look. We would have a transaction, okay? So we would go to the journal and we would write it in the journal. And then in the ledger, every page would be something like this. One page might be just for cash. One page might be just for accounts payable. One might be for common stock if we're an incorporated organization. Okay, so we would write the date and then how this account was affected, and then we would go to the next page, whatever the next one was. Okay. Now, something else that they have is called a chart of accounts. Most companies have so many accounts, you can't keep doing it. It gets too wordy. It gets too labor intensive to try to give each one a name and write down the name. It's easier if all the accounts are assigned numbers, and now you can use these account numbers to know what account you're going to have to either journalize or put in the ledger. I had a student come in one day. She was an accounting clerk at Walmart, and she brought in their chart of accounts one day to show us what the Walmart chart of accounts looks like. This thing must have been 8 inches thick, just page after page after page after page of account numbers, just one after the other, because something as big as Walmart, they've got a lot of accounts. So it can get pretty lengthy, but by doing it this way, it's a lot easier to keep them organized. Okay, earlier in chapter 1, I'd mentioned to you what a double entry system is. A double entry system means that we are going to record the dual effects of each transaction, okay? Each transaction has a receiving side and a giving side. For example, a company purchases supplies and pays cash. So the giving side is they give cash, and the receiving side is they get the supplies. So there's always going to be this two-sided or at least dual effects. You could have more than two accounts affected. You might have 3, 4, 5 accounts that are being affected. But that's what each transaction has. It has a giving side and a receiving side. This is called a T account. The T account simply lets us organize the different effects on that particular account. So at the top, you would simply put the name, okay? And then you would have your left side and your right side. And this can get a little confusing, especially if people work in a bank, because it's counterintuitive. The left side of a T account is called the debit side, and the right side of the T account is called the credit side. The vertical line divides the account into these left and right sides, okay? Now, the account category determines how to record the increases or the decreases. Something that's important to know is that a debit or a credit can be either a plus or a minus. This is one of the things that I was talking about with bankers. If you walk into a bank and you want to give them cash to put in your account, you might use the term, please credit my account for this much. But theoretically, that's backwards in the accounting world, okay? Increase and decreases in accounts. Whether an account is increased by a debit or a credit is determined by the account type. Assets, liabilities, or equity, each one is different. I'm going to show you a little example, like a little meme so you can see how that works, so you'll never forget it. Debits are neither good or bad, and neither are credits, okay? These next few slides are very important. Pay a lot of attention to these, spend some time on these. These are the rules of debit and credit. With an asset, if it's a debit, it's an increase in that asset. If it's a decrease in the asset, then it's going to be a credit. That's only for assets. For liabilities and owner's equity, it's the opposite. A decrease in a liability or owner's equity is a debit, and an increase in a liability or owner's equity is a credit. Now, notice something here. If you were to take and draw a T account right here, draw the T here, and then the vertical line right here at the equal sign, you would notice that on this side of the line, additions are debits, and on this side of the line, additions are credits. So if you draw that T account, and then on this side write assets, and on the other side of the line write liabilities and owner's equity, you'll never get them confused. You'll always remember that anything on the left side of the line, an addition is a debit. On the right side of the line, an addition is a credit. Now, to do a minus, it's just the opposite, okay? So if owner's equity addition is a credit, then obviously the debit has to be the negative. That's the minus. So that way you'll never forget it if you draw that. I have a lot of students that literally draw it right on the test. And then as the test is going through and the question comes up, okay, here's the transaction, what's the debit and what's the credit? And they get confused, well, which one's the addition, which one's the minus. That little drawing is what clues them in to which one it is. So those are the rules of debits and credits. And really, when you think about it, it makes sense, because in order for the equation to be equal, a positive cannot be on the same side on both sides of the equal sign. Because if they were, then it would never be equal. You'd never have an equal equation. So whatever's on one side has to be the opposite on the other side. That's the only way to keep the equation equal. Now, there's something else called normal balances, and a normal balance is simply it's the average positive amount for that particular account. Okay, it appears on the side where the increases are recorded. So assets have a normal debit balance, and liability and equity have a normal credit balance. You can't have a minus on the asset side, because that would mean that the asset is gone. The most you can have on an asset is a 0. Okay, you can't have a minus in an asset. It's gone. The asset is gone. You can't, if you were to take cash and your cash is gone, then you would have a 0 balance in the cash account. You can't have a negative balance, because now it would become a liability and it would go into a totally different account. Same thing with liabilities and equities, okay? A normal balance is going to be on the credit side for a liability. It's going to be on the credit side for an equity, okay? So this is, again, a very important slide. Normal balance, normal balance. Since the capital account is the major owner's equity account, it's increased by credits, as we said. Okay, so here's the increase in credits. Revenues increase equity, so they are also increased by credits. Withdrawals and expenses, on the other hand, decrease equity, so that means that those have to be on the opposite side. Therefore, the debit credit rules are opposite for those equity accounts. Okay, so if you have a withdrawal, then the withdrawal is going to have a positive debit balance, because it has to offset the owner's capital. So withdrawals and expenses are both increased by debits. Okay, so expenses are going to have a normal balance on the debit side, and so are withdrawals, because those have to offset the owner's capital. And the only way to do that is to have a debit balance. Now, when you're trying to determine what a balance is, it's really simple. You just take your debits and your credits and you combine them, and that's how you figure it out. So if this is the negative side, this is the positive side, then ideally the positive side needs to be greater than the negative side. And then you're going to have a normal balance where the positive side is. Okay, so $1,000 on the credit side and $500 on the debit side. Well, 1,000 minus 500, I would have a credit balance of 500. So that's how we calculate balances. Okay, we just combine debits and credits, remembering that one's going to be the minus, one's going to be the addition. So here's the T account that you would see for revenues. Okay, so a revenue addition is going to be on the plus side, and that's because we're adding it. When we're adding two credits, then that's exactly what we're doing. It's adding. It's going to be on the plus side. Revenue increases owner's capital. Withdrawals and expenses decrease owner's capital, so those have to go on the other side of the capital account. So that's why withdrawals are going to have a positive balance and expenses are going to have a positive balance, because those are being subtracted from owner's capital. Now, something else to note, and you'll see this a lot, okay? Revenue is an addition, withdrawal expenses, okay? Actually, let's just look at expenses for a minute. Revenue is an addition, expenses are a minus. Revenue minus expenses is net income. So net income is what gets added to the owner's capital. So here again, this has to offset revenue, which offsets the owner's capital. Okay. Revenue minus expenses is net income. So this is the normal balance slide for owner's equity. Owner's capital minus withdrawals plus revenues minus expenses. That's how we get our new balance in our owner's capital. But notice how the pluses and minuses have to work, okay? And you can use these screens. These screens are great to study as far as what your normal balances are. Remember, normal balances are going to be on the increase side of the account. So a withdrawal, if you're going to subtract it from owner's capital, has to have the opposite characteristics of the capital, which it does. Revenue, on the other hand, are going to be added to owner's capital, so those have to be the same. So there's our debit and our credit. Expenses, those are also going to be subtracted from our capital, so those have to have the opposite characteristics of owner's capital and the opposite characteristics of revenue. So I hope you see where this is starting to come together a little bit and make some sense. Normal balance. Okay. So this kind of summarizes the debit and credit rules. Okay. Remember that normal balances of assets, withdrawals, and expenses are debits. Normal balances of liabilities, capital, and revenue are credits. The normal balance is also what increases the account. Okay. Okay, using cash as an example. Here's an example right here. Let's see how the T account works, okay? Cash has a debit of 20,000 and a credit of 12,000. So in other words, at some point in time, we had a $20,000 debit to cash, and at another point in time, we had a $12,000 credit to cash. This increases it because it's an asset. The 12,000 decreases it because it's a credit. So the balance in the cash account is going to be combining these two together. So positive 20, negative 12, the balance in the cash account is 8,000. Okay, so 20 minus 12 is 8,000, and it's on the debit side of the T account. Okay. So let's talk about journalizing. How do we journalize our transactions? Okay, the process has 3 steps to it. First thing we're going to do is we're going to identify each account affected and its type. In other words, is it an asset? Is it a liability? Is it owner's equity? Then we're going to determine whether each account is increased or decreased using those rules of debit and credit. Okay, so if I bought supplies with cash, then that means that cash is going to be a negative and supplies is going to be a positive. Well, both of those are assets, so a negative to cash is going to be on the credit side, and a positive to supplies, another asset, is going to be on the debit side. So that's one of the things that we're going to do. So then we're going to record the transaction in the journal. And at the bottom, underneath it, we're going to put a brief explanation of what that transaction was. Something as simple as purchase supplies. That's all you need, okay? Total debit should always equal total credits. So in other words, on the journal, you'll put one amount under the debits, another amount under the credits. Those two numbers when you add them up, if there's more than one, but they have to be equal. Okay, I'll show you what we mean. So the journal entry has 4 parts to it: the date of the transaction, the title of the account to be debited, title of the account to be credited, and then the brief explanation. Okay, now some things to look at here. Okay, first of all, here's our date. The date was July 1st. Josie Smith deposited $45,000 of cash into her capital account. Okay, that was just money that she donated, she gave to the business to keep the business going or whatever. It's not revenue because it wasn't generated by our day-to-day activities. She just put this money in, so it goes straight to capital. Now, some things of importance here. First of all, the debits always come first. All the debits always come first. You will lose points if you switch those around, okay? Debits always come first. Credits come after the debits, and we indent. We indent our credits because when people are reading this, they need to be able to see the difference between debits and credits, and you've got to be able to pick this stuff out easily. Underneath that, there's our explanation, owner investment. Now let's look at the debit and credit part of it. Okay, if you'll notice, there's 2 columns, one for debit, one for credit. If I'm adding to cash, according to our rules, it's an asset. Adding to an asset is going to be a debit. So in this case, she put $45,000 in. So there's cash for $45,000. We also added to her capital account. Now, the capital account is on the other side of the T account, okay, of our accounting equation. So this is going to be the opposite. So to add to capital is going to be a credit. So I've got a debit for $45,000 and a credit for $45,000. Debits and credits in a transaction have to equal. If the numbers don't equal, you've made a mistake. You've got to go back and look at it again and correct it, okay? Now, if I had 2 or 3 debits and 2 or 3 credits, I add up all the debits, I add up all the credits, they need to equal. The numbers don't have to be the same, but the totals have to equal. And think about it for a minute. Our accounting equation, assets equals liabilities plus owner's equity. If the debits and the credits don't equal, then when I post these to their accounts, my equation is going to be off. It's not going to balance now. So debits and credits have to equal. Debits come first, credits come second, and then we indent our credits, okay? Very important. Transaction date, our accounts affected, and the dollar amounts. And there's the explanation of what we just did, okay? That is a typical general journal entry, okay? Very simple journal entry. Now from here, we're going to copy it into the ledger on the various account pages. So this is how we do that, okay? Short exercise right here. Okay, March 22nd. On account indicates account receivable, okay? So Lakeview sales consultants perform services for customers on account. On account indicating an account receivable or an account payable. Since this transaction will result in receiving cash, it's going to be an account receivable. In other words, they owe us money, so they're going to give it to us. We're going to receive it. That makes it an account receivable, okay? Now, we performed services for them, which means that we've gone out and we've earned some money, okay? Even though they haven't paid us, we've still earned it. And remember the rule, we have to recognize revenue in the period that they were earned, which is now. So we've got to recognize it. So that means that money that we've earned for performed services becomes revenue. In this case, it's called service revenue because that's how we earned it. We provided a service, okay? In this case, they owe us $4,000. So I'm going to have a debit to accounts receivable because it's an asset and I'm adding to it. That's $4,000. And I earned service revenue. Revenue is a credit when you add. So that's going to be a credit of $4,000. So I perform services on account. There's my explanation. There's my two accounts. And there's the money that will eventually change hands. That's my revenue that I earned. That's how much they owe me. Okay. Now on March 30th, Lake received cash on the account from the customer. This means that the company received payment on accounts receivable. One asset, cash, is increased because they gave me $3,000 towards the $4,000 that they owed me. Okay. So I have to go in and I have to decrease the accounts receivable by that same amount. They don't owe it to me anymore. So that's got to be a minus to the accounts receivable. So I'm going to have the debit to cash to increase that and a credit to accounts receivable because I'm decreasing it. Okay. These are both assets. I'm increasing this one, decreasing this one. So this is a debit. This is a credit. Received payment on account. Okay, so they paid me $3,000 out of the $4,000 they owe me. On March 31st, the company received a utility bill, which will be paid in the next month. The receipt of the bill is an expense. Okay, here again, expenses need to be recorded in the period of which they occurred. Okay, so even though I haven't paid it yet, I have to recognize it as a liability or an expense because I owe it. So the receipt of the bill is an expense. The fact the company that will pay it in the next month creates a liability. This is called accounts payable because I have to pay it. Expenses are increased by debits and liabilities are increased by credits. So remember the rules. Expenses are increased by debits. Liabilities are increased by credits. So I owe the utility company $130. And here's my explanation. Okay. Now on March 31st, salaries are paid to employees. Well, once again, salaries are expenses. That's the cost of doing business. Those are increased by debits. Cash, which is an asset, is decreased because I have to give it away. I'm paying it out. Therefore, cash is credited. So my salary expense is $2,300 because I'm adding to it. My cash is going to be a credit because I'm decreasing cash. I'm giving it away. I'm giving it to my employees as their salary for $2,300. The final entry is similar to the previous one. It's another expense, okay? This time it's for advertising. I paid $400 to an advertising company, to the Post or to the newspaper, whoever, okay? And in return, I got advertising. So my advertising expense is my debit. So that's going to be $400. I'm giving up cash. So if I'm decreasing cash, that's going to be a credit. And there's my explanation right there, paid advertising. So that's my final entry. Okay. Source documents. we have to have source documents because something has to trigger these transactions. Okay, they can be anything from a deposit ticket, an invoice, a check, stock certificates, whatever document triggers our transaction. Those are important because that's the paper trail that we're going to use later in case we have to find a mistake or some kind of an error. We'll have these. So now we're going to post things to the ledger, okay? So we've done our transactions, and now we're going to take and we're going to post them to the individual accounts. Now, in this case, I've got accounts receivable with a debit for $900 and service revenue for $9,000. So accounts receivable, 9,000, service revenue, 9,000. We performed legal services on account, which means we earned the 9,000. So there's revenue, but we haven't been paid for it yet. So that's receivable. We're going to add to receivable with a debit, add to revenue with a credit. So here's how that's going to look. The 9,000 is going to be posted to the debit side of the accounts receivable T account. And keep in mind, as we said, in the ledger, each one of these is going to have its own page. So this 9,000 is going to be copied into the debit side of the T account for accounts receivable. Service revenue, okay, and really all you're doing is following instructions. You're following directions. This is saying add $9,000 to the debit side of accounts receivable. That's what I did. This one's saying add 9,000 to the credit side of service revenue. So all I'm doing is basically what it's telling me. I don't have to figure anything out or think it through. Just do what it says, okay? So I do that and the 9,000 goes there. Now, 9,000, 9,000, everything balances. Now, the business receives $5,400 cash from the client towards their bill, okay? So if I received cash, that's going to be a debit for $5,400, but I've got to decrease accounts receivable. So that's going to be a credit for $5,400. Remember, decreasing an asset is a credit. So there's my transaction when I received payment on the account. Now I have to post these to the respective T accounts in the ledger. And again, just do what it tells us to do. What is it telling us to do? Well, it's telling us that we need to take $5,400 and put it on the debit side of cash. So there it is. We also need to take $5,400 and put it on the credit side of accounts receivable. So there it is, okay? Now, we can look at our balances. Our balance for cash right now is $5,400. Our balance for service revenue is $9,000. And our balance in accounts receivable is going to be the difference between $9,000 and $5,400. So our balance is going to be $3,600 on the debit side. Remember, normal balances on assets are going to be on the debit side. It's always on the plus side, the increase side of the T account. And there it is. So now we can go in and prepare the trial balance. Before we do that, though, I'm going to stop here for a second, and we'll pick this up again on part 2.